Welcome to the Capital News. I'm your host, Alex Karitis. Today is Monday, April 5th, 2021. Thank you so much for joining me. Hope you all enjoyed your weekend. Happy Easter to everyone out there. I did take Friday off, and of course, Friday was the release from the Bureau of Labor Statistics, the official March jobs report. So, of course, we are going to get to that today. That is going to be the bulk of today's podcast, as it has been for the past year whenever this report is released. We want to go through it in its entirety, not just read the headlines, not just follow the simple narrative of the financial mainstream media, which of course is what took place today. Of course, last Friday was Good Friday. Stock market was closed, but nonetheless, the jobs report came out, but you couldn't trade anything. Now, of course, the futures markets were trading, but that's neither here nor there. But today, obviously, the markets were open. So now they were digesting the jobs report, and that was the fuel for this market rally across the board today on Wall Street. Now, it was primarily contained with those bigger names, but that doesn't matter because the market is becoming more and more consolidated and is more and more dependent upon those larger names. This is consolidation. Ladies and gentlemen, this is the merger of big government and big corporations at its finest or at its worst, however you want to say it. That's what we are witnessing here. And it's all about the bogus narrative of the day, whichever piece of garbage they want to throw down our throats. That's all it is. Because we've been told that the narrative is about rotation. Well, we're getting out of NASDAQ. We're going to go into more industrials. We're going to get into more materials. We're going to go after those value plays. Now, all of a sudden, everybody's rushing back into those big names that comprise the NASDAQ. We know the names. So clearly something is amiss here. Clearly their narrative does not hold water. We understand that here at the Capital News. We understand the only narrative that matters is how much the central banks are printing and throwing into the system and whether or not the markets continue to buy it. If they continue to buy it, then they continue to go up. It doesn't mean it's a straight line up, but that's the trajectory. When that trajectory is broken, then we know it's pretty much game, set, match. Now, they'll, of course, attempt something. They will attempt to save the day when something breaks, and something is most definitely going to break, whether it's just system exhaustion, whether it's some sort of black swan event, whether it's a geopolitical event. It could be a number of things. The dominoes are set. All it takes is one to go, and the rest will start to follow. There's going to be a lot of resistance once these dominoes start to fall. That's when federal governments and central banks will even do more than what they have done over the past year. But that's going to be the true narrative that you have to pay attention to. That's going to be the true line of events that will occur in the future. And as painful as it's going to be, that's what actually has to happen. These dominoes have to fall. Liquidations have to occur. Malinvestments need to be flushed from the system. It's going to be bankruptcies, liquidations, restructurings, joblessness. And again, look at what we have just been through. But this is nothing but filling the void, not from savings, not from productivity, not from investment, but from the printing press. Now, if they want to make the argument that that's perfectly fine, that printing money is an equal or better substitute than savings, than productivity and investment, then let's have that conversation. Let's have it openly as a free society, or at least we're supposed to be a free society. Let's have that conversation amongst ourselves as individuals, as voters, as citizens. But they don't want to do that. Let's ask those basic questions. If the printing press is an equal or better substitute to savings and investment and productivity gains, well, then let's just print all the money. Let's print more. Let's give people bigger checks. Why are we paying taxes? Because clearly, given the size of our budget deficits over the past couple of years and foreseeable future, clearly tax revenue it's not any type of constraint to the size of deficit that our government is willing to run and our central bank, the Federal Reserve, is willing to finance? Let's just ask some of these very basic questions. Can we at least do that for the sake of our republic? Of course, the answer to that is no. We can't even ask those types of questions. They will not answer those types of questions either. But that is what is needed. That should be demanded by everybody. But pay attention. No, pay more attention to the reality TV show and the divide and conquer messages and tactics and strategy that is broadcast day and night 24/7 on the mainstream media down in Washington, D.C., over on Wall Street. Pay attention to the circus. Go complain to the clowns. Go complain to the monkeys. You're not going to get any satisfaction, I guarantee it. But keep paying attention to it and then scratch your head and wonder why nothing gets solved. So a couple other things before we get to the jobs report. I want to go through market performance since it was a big rally today across the board, especially, but not with the Russell 2000, the small cap index. That was up for the day, but not as much as was the case for the S&P 500, the NASDAQ, and the Dow Jones Industrial Average. But a couple things I want to mention because I received a couple of comments on a previous podcast from a couple of long-time listeners, and these are a couple of people from up north, our friends up north, up in Canada. So it's always interesting to get that global perspective, and I'm very glad that they're part of this podcast. But they both mentioned to me the outrageousness of the Canadian real estate market, which of course is no surprise. That has been the case in Canada for quite some time, and a lot of people have been expecting that market to collapse for quite a while, and it just continues to gain steam. Now, a lot of this is because a lot of foreign interest, so from other countries, from Asia, from Russia, are coming in to Canada and just buying everything, anything they can get their hands on. And I'm sure there are many situations in Canada, like there are here in many many cities across this country here in the States, where properties are being sold sight unseen for tens of thousands of dollars over asking price. And one audience member in his comment noted that one house, one property in Toronto sold for $575,000 above list price. I'm going to take him at his word that that was the case, because I can believe that type of insanity, depending on, obviously, the size of the house, location. Now, I don't care if that's U.S. dollars or Canadian dollars. That's ridiculous. And, of course, you have all of these realtors and real estate agents. They probably all patting themselves on the back thinking they're geniuses. They have absolutely nothing to do with this. Same thing with all of these, fantastic stock pickers out there. Everybody thinks they're a stock picking genius because stocks just go up. And for the same reason, housing prices are going up for the same reason that stock prices keep going up. No matter what you throw at them, no matter what rationale comes across the newswire, no matter what the story is, these things just keep going up because we keep printing money. Okay? And then you now have to ask yourself, well, is it really that the value of these financial assets, whether that's real estate, whether that's stocks, are they really going up, or is it the currency that is really collapsing, falling through the floor? Different perspective. Maybe that's how we should be looking at it. But nonetheless, this is pricing so many people out of the markets to buy their first home, or to sell their current home to go buy another one, depending on where they want to go. This problem is not going away anytime soon either, because we have Christine Lagarde, as we mentioned last week, the president of the ECB, taunting the markets. Bring it on, baby. Bring it on. You want to fight the Fed? You want to fight the ECB? You want to fight central banks? Bring it on. See what happens to you. That's what she was saying, reading between the lines. Bring it on. This is their arrogance. So when you have this lethal combination of central bank ignorance and arrogance, oh boy, how do you think this is going to end? I would guess not so hot. But we'll see what happens. So I thank my Canadian listeners, and anything else that you guys come across, please send it my way, whether it's via a comment on YouTube or the website or sending me an email. Please do so I can keep the broader audience informed of these events. And another thing that they both mentioned to me as well is that in the province of Ontario, Canada, they have entered into a 1-month lockdown. Now, this started a few days ago. So we got another month for the poor people in Ontario, Canada, at least in Ontario, to be locked down and restrictions for another month. Hits just keep on coming, ladies and gentlemen. And of course, this is likely going to cause people to end up leaving Canada, leaving various states within the United States, depending on their lockdowns and restrictions. And perhaps people just leaving the United States entirely in other places in Europe. I mean, and that is a very sad and tragic statement to make, because places like Canada, the United States, Western Europe, those are supposed to be the countries that other countries around the world are supposed to look to for guidance and for leadership and for inspiration as to how to sort of run, if you will, a successful economy and society. And now we have those countries, those nations, in disarray, and the people within those countries wanting to leave those countries to go elsewhere. This is a true, sad state of affairs, and it is not getting any better whatsoever. And I hope listeners out there have listened to the podcast we did last week on the Milgram experiment to get a better understanding as to what is going on here, because I am convinced beyond a shadow of a doubt that that is what is taking place. This is a massive Milgram experiment. You can disagree, and that's perfectly fine, but I'm convinced. So let's get to some market performance, and then we'll get to the March jobs report. So we have the dollar index was weak a little bit across the board earlier today. Overnight, it's relatively flat at 92.67 on the dollar index. A lot of the weakness across those currency pairs during the day session here in the States have reversed, and the dollar is gaining against the euro, pound, Aussie dollar, New Zealand kiwi, and pretty much all of the other majors right now in the overnight session. So we'll keep you updated on that. And of course, typically when you see this dollar weakness, that's usually a little bit of a pickup for equities, but that's not always the case. So we can start to see some of these breakdowns of correlations here, and that's just something I want the audience to be mindful of. Overnight futures trading, we have the Dow Jones down about 0.25%. The S&P 500 is down 0.2%. The NASDAQ 100 is flat. Japanese cash trade is down 1%. A sea of green across the board, across the pond in Europe. And the Australian cash trade is up about 0.9%. And Chinese stocks are currently down about 0.3%. So as I stated at the top of the podcast, biggest movers and shakers were those big names. Apple putting on a gain of 2.3%. Tesla putting on a gain of 4.5%, now trading at $691 a share. Microsoft putting on a gain of 2.8%. Amazon putting on a gain of 2%. Facebook up 3.4%. Visa up 1%. And Intel putting on a gain of 3%. On the commodity front, oil sold off today. Oil sold off big today. And this sort of runs counter to the bogus narrative about one of the reasons why stocks kept going up today was because of the better-than-expected jobs report, which, of course, we're going to get to here momentarily. But wouldn't one think that if you had a stellar jobs report, according to the analysts, according to the experts, and that was enough fuel for equities to rise well above 1% today, then shouldn't oil also have gone along for the ride? Because shouldn't that have meant that demand is picking up, that demand is here, that future demand is only going to increase? Isn't that what somebody should sort of understand from a stronger jobs report? But that wasn't the case when oil sold off a few percentage points today. It's up right now overnight, but that's not the case during the day session. WTI $59.18 a barrel, so below $60. Brent at $62.60. Natural gas also sold off earlier today, $2.52. Gold and silver Well, nothing miraculous there with either of these precious metals. Gold at $1,733 an ounce. Silver, $24.90 an ounce. This is on the back of nothing but manipulation and market rigging as far as I'm concerned, because other commodities were up. Lumber was up. Wheat was up. Copper was up. Copper's at $4.10 a pound. But gold and silver just sort of hanging out there. Not much to see. Now, again, to me, this is buying opportunity. This is buying opportunity because there hasn't been much movement. Buy low, sell high is the name of the game. Now, people shouldn't necessarily be patting themselves on the back for being stock pickers in this type of environment. I'm surely not patting myself on the back. I have these stocks, these high flyers that are going up just like everybody else, whether it's individually or whether it's in an index fund or an ETF. I'm not patting myself on the back because this stuff's going up. I will pat myself on the back, however, if gold and silver goes up and these gold and silver mining stocks go up and the commodity play continues. That's off of analysis. Now, I could be 100% wrong on that, and I will admit that to this audience. But I am in this for the long term, and I think I will be rewarded. You got to play the game that you think is best suited for you, but I tell you what I'm doing. And on the bond front, Uncle Sam's 10-year junk note is at 1.69%. So down overnight, 1.69%. All right. Oh, real quick, sorry, got to put this in there too, because the hits just keep on coming with our fearless leader at the Treasury Department, Janet Dingbat Yellen. She now wants a coordinated global corporate tax rate. These people are out of control. Last week, she wants to give $650 billion U.S. taxpayers' dollars, to the IMF so we can bail out poor and middle-income countries. And by design, that would be also bailing out their bondholders, whoever those individuals or institutions may very well be. So it's just one bailout after the next. And of course, she doesn't even have to go to Congress to give away that money because it's under the threshold. I would like to know. I'm going to have to look this up. I don't know what the threshold is. I don't know who signed this law who signed this bill into law. I don't know who wrote it, but this is ridiculous. $650 billion she wants to give to the IMF to bail out these nations. And then she says, well, don't worry about it. Yes, we're going to have to fill up the Treasury again with that $650 billion. So we're going to have to issue more debt. But she says, don't worry. Okay? So anybody who was concerned, don't worry, she says. It'll just be a wash. Because what we earn from these poorer countries, from the IMF bailing them out, will pay for our debt costs when we have to go out into the market and issue $650 billion worth of U.S. Treasuries. Now, nobody wants this garbage, so the Federal Reserve's going to have to buy it all up, too. What a sick and twisted game that they are playing, and it's making the headlines. They talk about it openly, and nobody says a thing. Fantastic. The employment situation, March 2021. Total non-farm payroll employment rose by 916,000 in March, and the unemployment rate edged down to 6%, according to the BLS. These improvements in the labor market reflect the continued resumption of economic activity that had been curtailed due to the coronavirus pandemic. Job growth was widespread in March, led by gains in leisure and hospitality, public and private education, and construction. First to the household survey data. The unemployment rate edged down to 6% in March. The rate is down considerably from its recent high in April of 2020, but is 2.5 percentage points higher than its pre-pandemic level in February of last year. The number of unemployed persons at 9.7 million continued to trend down in March, but is 4 million higher than in February of last year. Among the major worker groups, the unemployment rate for Asians rose to 6% in March, following a decline in the previous month. The jobless rate for Hispanics edged down to 7.9% over the month, while the rates for adult men 5.8%, adult women 5.7%, teenagers 13%, whites 5.4%, and blacks at 9.6% changed little. Among the unemployed, the number of persons on temporary layoff declined by 203,000 in March to 2 million. This measure is down considerably from the recent high of 18 million in April of 2020, but is 1.3 million higher than in the month of February of last year. The number of permanent job losers at 3.4 million was little changed in March, but is 2.1 million higher than February of 2020. So it's interesting to see that permanent job losers continues to plateau. Now, I guess you can put a silver lining around it that it hasn't gone up, but 3.4 million is still a serious number and is still cause for concern as far as I am concerned. The number of long-term unemployed, those jobless for 27 weeks or more at 4.2 million, changed little over the month, but is up by 3.1 million since February of 2020, so also not a great thing. In March, these long-term unemployed accounted for 43.4% of the total unemployed. The number of persons jobless 5 to 14 weeks declined by 313,000 to 1.9 million, and the number of persons jobless less than 5 weeks at 2.2 million was essentially unchanged over the month. So those long-term unemployed, those jobless for 27 weeks or more, again, is at 4.2 million. Little change, and of course, those who are unemployed for a longer period of time makes it more difficult to become re-employed, if you will. Skills atrophy, people wonder why you've been out of work for so long, etc., can make it a little bit more difficult for these individuals. Hopefully, though, that's not the case, but we shall see. The labor force participation rate changed little at 61.5% in March. This measure is 1.8 percentage points lower than in February of 2020. The employment population ratio at 57.8% was up by 0.2 percentage points over the month, but is 3.3 percentage points lower than in February of 2020. Now, these are both broader labor market aggregates, if you will, that sort of shows the bigger picture as to what's really taking place. And while we're seeing some steady improvement in both of these measures, it's not great. So these are the numbers I like to take a better look at. Labor force participation rate, again, at 61.5%, and the employment population ratio at 57.8%. Probably not going to have enough time to get into these numbers in greater detail today because of the other conversation I had prior to this report. So we'll talk about these figures later this week, just to sort of give the historical context and perspective of these figures, which I've done in the past, but just to give an update as to where these numbers stand today and where they have been historically speaking. The number of persons employed part-time for economic reasons at 5.8 million changed little in March, but is 1.4 million higher than in February of 2020. These individuals who would have preferred full-time employment were working part-time because their hours had been reduced or they were unable to find full-time jobs. The number of persons not in the labor force who currently want a job was about unchanged at 6.9 million in March, but is up by 1.8 million since February of last year. These individuals were not counted as unemployed because they were not actively looking for work during the last 4 weeks or were unavailable to take a job. Among those not in the labor force who currently want a job, the number of persons marginally attached to the labor force at 1.9 million was essentially unchanged in March, but is up by 416,000 since February of 2020. These individuals wanted and were able and available for work and had looked for a job sometime in the prior 12 months, but had not looked for work in the 4 weeks preceding the survey. The number of discouraged workers, a subset of the marginally attached who believe that no jobs were available for them, was 523,000 in March, essentially unchanged from the previous month. So isn't it fascinating to see that a lot of these broader statistics, the long-term unemployed, those who are looking for full-time but can't find it, etc., those who are marginally attached, are they're not much change to them. I should say essentially unchanged. I'll just use their vernacular. Essentially unchanged from the previous month. Now, wouldn't one think that if this was such a blowout jobs report, such a strong economic indicator of growth, that there would be some significant changes in these data points? That is not the case. The BLS is even stating as much. Essentially unchanged from the previous month. Now, if they start to change their lingo because the facts on the ground are changing, then that'll be a good thing. But I just don't see how you can claim that this is a great jobs report, which leads stocks to rally across the board on the major averages, up over 1% today, off of this. Just does not jive. But they're just going to grasp at anything they can to justify the liquidity push, because that's all that's continuing to push these stocks higher. This is some supplemental data to the household survey. In March, 21% of employed persons teleworked because of the coronavirus pandemic, down from 22.7% in the prior month. These data refer to employed persons who teleworked or worked at home for pay at some point in the last 4 weeks, specifically because of the pandemic. In the month of March, 11.4 persons reported that they had been unable to work because their employer closed or lost business due to the pandemic. That is, they did not work at all or worked fewer hours at some point in the last 4 weeks due to the pandemic. This measure is down from 13.3 million in the previous month. Among those who reported in March that they were unable to work because of pandemic-related closures or lost business, 10.2% received at least some pay from their employer for the hours not worked, little changed from the previous month. And that's another point that we have to still contend with, is the backlog of businesses that are likely going to close up for good once a lot of stimulus and other programs expire. And just because a lot of the changes that have been taking place across the economy, depending on what state you're in, this will obviously have some larger impacts. So that is something that we still have to contend with. Same is the case with respect to evictions and foreclosure moratoriums. That is still something that we have to contend with. Among those not in the labor force, in March, 3.7 million persons were prevented from looking for work due to the pandemic. This measure is down from 4.2 million the month before. To be counted as unemployed by definition, individuals must either actively be looking for work or on temporary layoff. On to the establishment survey data. Total non-farm payroll employment increased by 916,000 in March, but is down by 8.4 million or 5.5% from its pre-pandemic peak in February of 2020. Job growth in March was widespread, with the largest gains occurring in leisure and hospitality, public and private education, and construction. In March, employment in leisure and hospitality increased by 280,000 as pandemic-related restrictions eased in many parts of the country. Nearly two-thirds of the increase was in food services and drinking places, a gain of 176,000. Job gains also occurred in arts, entertainment, and recreation, a gain of 64,000, and in accommodation, a gain of 40,000. Employment in leisure and hospitality is down by 3.1 million or 18.5% since February of last year. Now, it's also important to note that most of these jobs are not new jobs. They are simply businesses reopening and hiring back former employees, and perhaps, of course, new employees as well, but the bulk of them are simply jobs that were lost coming back. This is not new economic growth. In March, employment increased in both public and private education, reflecting the continued resumption of in-person learning and other school-related activities in many parts of the country. Employment rose by 76,000 in local government education, by 50,000 in state government education, and by 64,000 in private education. Employment is down from February 2020 levels in local government education by 594,000. That's negative. State government education is down 270,000. And private education is down 310,000, again from February 2020 levels. Construction added 110,000 jobs in March, most likely on the back of the housing boom that's taking place, following job losses in the previous month, a loss of 56,000 that were likely weather-related. Of course they were. Employment growth in the industry was widespread in March, with gains of 65,000 in specialty trade contractors, up 27,000 in heavy and civil engineering construction, and 18,000 in construction of buildings. Employment in construction is 182,000 below its February 2020 level. Employment in professional and business services rose by 66,000 over the month, but is down by 5,000 since February of 2020. Again, this is professional and business services. In March, employment in administrative and support services continued to trend upward, gaining 37,000, although employment in its temporary help services component was essentially unchanged. Employment also continued on an upward trend in management and technical consulting services, up 8,000, and in computer systems, design, and related services, putting on a gain of 6,000. Manufacturing employment rose by 53,000 in the month of March, with job gains occurring in both durable goods up 30,000 and non-durable goods up 23,000. Employment in manufacturing is down by 515,000 since February of last year, so still a long way to go there. Transportation and warehousing added 48,000 jobs in March. Employment increased in couriers and messengers, up 17,000. Transit and ground passenger transportation up 13,000. Support activities for transportation up 6,000, and air transportation also up 6,000. Since February of last year, employment in couriers and messengers is up by 206,000, or 23.3%. We're a warehouse in Amazon world. That's what we're dealing with here. It's the big box stores. They were essential. That's where the jobs went. While employment is down by 112,000, or 22.8%, in transit and ground passenger transportation, and by 104,000, or 20.1%, in air transportation. Employment in the other industries, other services industry, increased by 42,000 over the month, reflecting job gains in personal and laundry services, up 19,000, and in repair and maintenance, gaining 18,000. Employment in other services is down by 396,000 since the month of February of 2020. Social assistance added 25,000 jobs in March, mostly in individual and family services, gaining 20,000. Employment in social assistance is 306,000 lower than in February of last year. Employment in wholesale trade increased by 24,000 in the month of March, with job gains in both durable goods up 14,000 and non-durable goods up 10,000. Employment in wholesale trade is 234,000 lower than in February of 2020. Retail trade added 23,000 jobs in March. Job growth in clothing and clothing accessory stores added 16,000. Motor vehicle and parts dealers gained 13,000. And furniture and home furnishing stores gained 6,000. Was partially offset by losses in building material and garden supply stores, losing 9,000. In general merchandise stores, losing 7,000. Employment in retail trade is 381,000 below its February 2020 level. Employment in mining rose by 21,000 in the month of March, largely in support activities for mining, gaining 19,000. Mining employment is down by 130,000 since a peak in January of 2019. Financial activities added 16,000 jobs in March. Why? For what? Stocks just go up. Why do you need to hire more people if we have a perpetual money-making machine? I digress. Job gains in insurance, carriers, and related activities up 11,000. In real estate, up 10,000. There it is, up 10,000 for real estate. More than offset losses in credit intermediation and related activities, losing 7,000. Financial activities has 87,000 fewer jobs than in February 2020. Everybody wants to be a realtor in this market. Employment in healthcare and information changed little in the month of March. In March, average hourly earnings for all employees on private non-farm payrolls fell by 4 pennies to $29.96. Average hourly earnings for private sector production and non-supervisory employees at $25.21 changed little, a gain of 2 cents. The large employment fluctuations over the past year, especially in industries with lower paid workers, complicate the analysis of recent trends in average hourly earnings. Quite so. Then give us the median as opposed to the average. The average work week for all employees on private non-farm payrolls increased by 0.3 hours to 34.9 hours in the month of March, following a decline of 0.4 hours in the prior month. In manufacturing, the work week increased by 0.2 hours to 40.5 hours over the month, and overtime increased by 0.1 hours to 3.3 hours. The average work week for production and non-supervisory employees on private non-farm payrolls rose by 0.3 hours to 34.3 hours. On to some of the revisions The change in total non-farm payroll employment for January was revised up by 67,000 from a positive 166,000 to a positive 233,000, and the change for February was revised upward by 89,000 from a positive 379,000 to a positive 468,000. With these revisions, employment in January and February combined was 156,000 higher than previously reported. The next employment report will be out on Friday, May 7th at 8:30 a.m. And of course, the fine print, as in previous month, some workers affected by the pandemic who should have been classified as unemployed on temporary layoff were instead misclassified as employed but not at work. However, the share of responses that may have been misclassified was highest in the early months of the pandemic and has been considerably lower in recent months. Okay, with all of that said, the unemployment rate in March of 2021 would have been 0.4 percentage points higher than reported. So there you have it. We still have those gimmicks being played. The official rate, nonetheless, is at 6% as opposed to 6.4%. And it'll be interesting to see how the Federal Reserve responds to this as well, especially if the unemployment rate continues to go lower, because they have been calling out the official unemployment rate, saying, no, it's not 6.3% as it was previously. It's not 6.2% as it was last month. No, it's closer to 10%. Well, what is it now? Is it now 9.8% in the Fed's head? Or is it still closer to 10, 10.2, or is it even higher than that? What's the narrative they want to push? So that's all it is. It's story time for the children. It's story time for the crackheads on Wall Street. That's all it is. Give the financial media something to discuss for their 8-hour day, 24/7 network, whatever platform, whatever news station you're watching, whatever they do. It's just to fill the airwaves. Pay attention to what's really going on behind the scenes. Stay diversified, stay vigilant, and stay with the Kapital News. I am Alex Koritis. Godspeed.